The number that vetoes a stock in 2 minutes once saved me from bankruptcy before I read a word. A company posted record profits and was 30 days from collapse. Its balance sheet screamed the danger that its story hid. Tonight you learn the 2-minute check that finds it first. The story that a company tells you is always the last thing to trust. 3 lines on one page can veto any stock before you fall in love. Here's the paradox that fooled thousands of smart investors. A firm can earn more than ever and still go broke this year. Because profit is an opinion and cash is a hard fact. The gap that hides between them is where fortunes die, plain on the page. Now open the balance sheet and ignore the pretty story. You are looking for just 3 brutal numbers. Line 1. How much cash does the company actually hold? Line 2. How much debt is it buried under in the ledger's red ink? Line 3. Can it pay the bills due within 1 year? Start with cash versus debt, the survival test, or you get wiped out. Say a firm holds $10 million in cash on hand, but it also owes $80 million in loans that come due. That is $8 of debt for every dollar of cash. The number that turns a good story into a trap is leverage. Debt does not care how brilliant the business sounds. When the loans come due, the lender is paid before you, and you are left broke. If the cash is not there, the company is wiped out on the account page. Now here's the ratio that reveals near-term survival. The current ratio pits short-term assets against short-term bills. Divide current assets by current liabilities and read the result. Above 1.5, the firm can comfortably cover its year. Below 1.0, it cannot pay what is already due. A ratio under 1 is a company living on borrowed time, a mistake that will cost you dearly. The moat that everyone praises means nothing here. A wide moat with an empty vault still falls to a siege. Now here's the third line that catches the slow killers where the chart turns red. Compare the total debt to a single year of profit. If debt is 10 times yearly profit, the risk is severe. It would take a decade of perfect years just to repay it, or you go bankrupt. And perfect years almost never arrive in a row under a dark ceiling. One recession, and the whole tower of debt comes down. The company that borrows its growth borrows its ruin too. Now run the 3 checks together on that example firm. 10 million cash, 80 million debt, a ratio of 0.7. Every single line flashes red before you read the story, and the fees ate the rest. You just vetoed a stock in under 2 minutes flat. The story that would have hooked you never got a chance. Now feel how much this protects your own money. Most investors buy the story, then read the numbers too late in the gold lamplight. You will read the veto first and walk away calm. The habit that saves your capital is boring and fast, and you never recovered. 2 minutes of arithmetic beats 2 years of regret. Now here's a challenge you can run tonight as the red ink dries. Pick one stock you already own and toll its balance sheet. Find the cash, the debt, and the current ratio. Comment the 3 numbers you find and we will read them together. Guess whether your favorite company passes before you check, or you get wiped out on a gray page. Most people are shocked by how much debt hides in plain sight. Now here's why Graham built this veto in the first place. Benjamin Graham watched fortunes vanish in the 1929 crash. He saw that debt, not bad luck, destroyed most investors. So he demanded a fortress balance sheet before any story. Warren Buffett kept that rule and turned it into billions. They both start at the debt, and so should you. Everything here comes from the investing classics linked below. Listen to them free with the Audible trial in the description. Now here's the trap even careful investors fall into, and you are left broke, plain on the page. Some debt hides off the balance sheet in leases and pensions. Always read the footnotes where the real risk is buried. The debt that a company hides is the debt that kills it. So skim the notes for the word obligations and dig in the ledger's red ink. Now picture 2 firms with the exact same great story. One holds cash and little debt. The other is drowning a mistake that will cost you dearly. The story sounds identical, but only one survives a storm. The balance sheet is the only place that difference shows on the account page. That is why you read it before you believe a word. Now here's what the veto protects you from most. It protects you from the exciting company that quietly bleeds, from the growth story funded entirely by borrowed money, or you go bankrupt where the chart turns red. From the dividend that is really just more debt in disguise. A 2-minute check that stops a 2-year mistake. Now here's a fourth number that sharpens the whole test. The interest bill that eats the profit is the number nobody quotes you under a dark ceiling. Compare a year of profit to the yearly interest on the debt. If interest swallows most of the profit, the firm is fragile, and the fees ate the rest. The company that works only to pay its lenders owns nothing. The runway that a cash-burning firm has left is the only clock that matters in the gold lamplight. Divide the cash by the monthly burn, and you get the months left. When the runway ends, the firm must beg for money or die. The dilution that rescues a company quietly robs its shareholders. New shares save the business, but shrank the slice you own as the red ink dries. So a rescue can look like a win and feel like a loss. Now here's a trick to see through a fattened balance sheet. The equity that looks fat is often just goodwill that will vanish. Goodwill is the premium a firm paid for past acquisitions, and you never recovered on a gray page. Strip it out to find the hard, tangible book value. The number that survives that cut is the one you can trust. Now here's the pattern that warns of a slow bankruptcy. Watch for rising debt, rising receivables, and falling cash together. That trio is a company bleeding while it smiles for the camera, plain on the page. The mistake that ruins beginners is trusting the story over the ledger, or you get wiped out. The cash that a company hoards is the cash that lets it hunt in a crash. A fortress balance sheet turns a recession into a shopping trip. So strong books are not just safety, they are a weapon. Now here's how the pros read all this in one glance in the ledger's red ink. They read cash first, debt second, and the ratio third. In 10 seconds, they know if a stock deserves the next hour, and you are left broke. The discipline that feels slow at first becomes instant, and that instinct is what quietly protects your capital for life on the account page. Now picture the debt maturity wall that topples firms. The debt that comes due next year is far more dangerous than debt due in 10. A great company can still choke on a bill it cannot roll over. So always ask when the debt is due, not just how much. A mistake that will cost you dearly where the chart turns red. The lender that will not extend you is the storm you cannot see. Now step back and hold the whole method in one view. Cash against debt, the current ratio, and debt against profit. 3 lines that veto a stock before its story can seduce you under a dark ceiling. Read them first, every single time, without exception. And the worst mistakes will pass you by untouched, or you go bankrupt. Run this before every buy, and fake safety loses its mask. Subscribe, and each day brings one more method the pros guard in the gold lamplight. Master these 3 numbers, and you read the truth cash tells. Now you decide what skill we build next together. Vote A for normalized earnings, seeing through one freak year. Vote B for the circle audit, mapping what you truly understand as the red ink dries. The comments choose, and I teach the winner tomorrow, and the fees ate the rest. Until then, remember the veto that guards your capital. 3 numbers, 2 minutes, and 1 story you never had to hear. You just learned the balance sheet triage that saves your money first.